Hi, everyone. My name is Mark Vina, host of the Smart Tech Check podcast. Today is Friday, July 12th, 2024. Jeffrey Hirsch is CEO of Hirsch Holdings, editor in chief of the Stock Traders Almanac, and publisher of Almanac Investor at stocktradersalmanac.com. Jeff is the author of the Little Book of Stock Market Cycles and Super Boom: Why the Dow Will Hit 38,820 and How You Can Profit from It. He worked with founder Yale Hirsch over the last 20 years, taking over from him in 2001. A 35-year Wall Street veteran, he appears on CNBC, Bloomberg, Fox Business, and many other prominent financial media outlets. Now in its 57th year, which is really scary, the Stock Traders Almanac has been published every year since 1968. Jeff, I'm thrilled to have you on the podcast. How are you?
Great to be with you, Mark.
Now, normally on my I'm sorry, go ahead, please.
I just finished proofing the 58th edition. I just sent it back to the typesetter for them to do the edit. So we're still running. Legacy's still going on.
That's amazing, though. 58 years, that's unbelievable. Yeah. We could talk about it offline about that. But as you know, most of the viewers who watch my podcast know, I typically focus on technology trends, market headwinds, tailwinds. I don't talk a lot about financial issues. Every once in a while, a company meets or exceeds its revenue and margin commitments for the quarter. I may talk a little bit about that, but I'm not in the business of making stock trader recommendations, because it's kind of scary to me. Yeah. Technology is wonderful, but you're the kind of guy who has an incredible reputation for picking the horses right. And it's really great getting you on the podcast. And one of the things I want to talk about, I'm going to bring up your bio in a second. But the thing that's really interesting to me about what you do is that a lot of people, want to get into the market. There's a lot of technical minutia analysis. It's not just as simple as, buy low, sell high. You really have to be much, much more equipped. And guys like you really can, help the average investor who wants to get into the market with some level of knowledge. But before we get into that, because we're going to get into some of the publications you have, and then we're going to talk a little bit about some of the macro trends that you're seeing at a market level, let's talk about you first and foremost.
Me?
Yes.
What do you want to know about me?
Talk to me about your bio, your background. I talked a little bit about it.
I was born, bred, weaned, raised in the Almanac. I grew up with it in my house. Pop started the book the year I was born, or started the company the year I was born, 1966. He left this outfit called Indicator Digest out of Palisades Park, New Jersey, started by his cousin, my godfather, Sam Coslow, who was a songwriter and a Hollywood producer, and wrote a couple of famous old songs, "My Old Flame" and "Cocktails for Two."
Oh my God!
And
wow.
he had sold his publishing business to RCA for stock years and years ago, and the stock went down. So, smart guy like him was like, "What?" He figured it out. He became a student in the market, and ended up in 1961, I believe, wanting to start this publication called Indicator Digest. We could put all the market's indicators, in one publication. He ran an ad in Barron's, an A/B split, two different headlines. The ad hit. He calls up Yale, my father, Yale Hirsch, who started everything, and asked him, "Can you come work for me and run the business? Be my operator, my chief officer." So, Dad was in the music business at the time too. He had a degree from Brooklyn College on the GI Bill from World War II in music. And I think that I'm going to get into that a little bit, but I think the music really helped him recognize the cycles and patterns in the market. There's something about that worked for him. But after a few years with Sam, who I named my first child after, he decided to go out on his own. He had this epiphany to take all the markets, patterns, cycles, indicators, and strategies, and put them in a calendar format so that he could follow the market's calendar along with his own. And here, got the almanac here. I don't know if you can see it I keep one at the desk and home also. But and it hit, and he started marketing it to brokerage firms. He had a salesman that went around in New York, and I grew up with that. He had a place in the city until about like 73, and then he moved. He gets tired of commuting and built an office in the house. So we had the phones, we had customer service. I worked in the mailroom. I shipped books. I did the calculations. I have this little itty bitty ruler here that I still use, which I track the upticks in the market in Barron's Lab pages. When I was a kid, and then after sowing some oats and seeing the world a little bit, I decided to go work for him full time in late '89.
Well, and we're going to get into this as we talk about the almanac itself. But here's a question I have for you. And it just occurred to me just a few moments ago.
Mm-hmm.
In the early days of the almanac, in the late '60s, the early '70s, we had calculators. I mean, how did you do all that analysis without a spreadsheet? Now, and the reason why I say
you use spreadsheets. They were paper spreadsheets.
Paper spreadsheets.
I used to run the ruler. I would add up the numbers and write them in a spreadsheet on a piece of graph paper, like we used to call it back then, and then add it up with an adding machine. I used to be able to be pretty quick, like a bookie or whatever, like a bookkeeper. Not a bookie, a bookkeeper. But we did it all, and we had papers that we would add to each year. I had files and file cabinets. It was, and then to give myself a little credit, when I came on, one of the first things I did was to take all that. When I came on full time, the first thing I did was take all that stuff and converted it to Excel for DOS back in like 90, 91 too.
Oh, it must have been manna from heaven when VisiCalc came out, and then Lotus 1-2-3.
I was straight to Excel. I'm still in Excel.
You went right to Excel.
What's that?
You went right to Excel.
It's what, and it's the thing I'm still using now, and then I converted it to Windows. And now my partner, Chris, who, God bless him, he put it all in this database for us. We have a SQL Server database where we query it, and all this stuff's in there. So, it took a lot longer to produce the book back in, 73 than it did in 23 or 24 this year. So, and, one of the things that was interesting was watching the market change. I mean, one of the key to the Almanac legacy is not just what we learned and what we discovered way back when. It's evolving with the market. I mean, things change.
Right.
Behavior changes, behavioral finance changes, institutions behave differently. We've seen October change. And one of the things that we saw when I started with Dad was this impact of the bi-monthly payroll deductions going into 401ks, retirement accounts that changed the makeup of the typical month in the stock market. But we're constantly tracking different things and trying to look at things from not necessarily just an objective standpoint, but from a real observational, like a scientific standpoint, like a Darwin or something like that, where you're seeing what's causing things to change. Right. Different events that mark the beginnings and ends of things, whether it be, the Gulf of Tonkin resolution or the Arch Ferdinand, getting assassinated, where it was, big secular macro, right. which is what that Super Boom book that you mentioned was built. That's a cycle that Yale discovered back in '76.
Hey folks, this is Mark Vina, CEO of Smart Tech Research. Smart Tech Research is proud to have Aura sponsoring my Smart Tech Check podcast. Aura security software is the all-in-one digital safety net for the whole family. It's literally like having a personal cyber guardian that protects all of the devices in your home on a 24/7 basis. What's more, its AI functionality stands out as it constantly learns and adapts to threats, keeping your family and you safe around the clock. It's a must-have solution for anyone serious about online security. Stay tuned for a special no-obligation promo offer for Aura that will give you cybersecurity peace of mind.
Hi, I'm Anna with Smart Tech Research. Whether you're browsing the web, checking emails, monitoring your children's online behavior, spam calls and identity protection, and conducting online transactions, Aura has your back, ensuring a secure and seamless experience every time. Aura's comprehensive security solutions are compatible with Microsoft Windows, Apple Mac OS, Android, iOS, and iPad OS devices. For an exclusive 14-day no-obligation trial version of Aura, use the on-screen QR code or visit the website shown here. Aura is the smart, simple way to stay safe online.
These 500% moves that the market makes following war and inflation. And I made the same forecast in 2010 with the Dow around 10,000, and now we're up at 40, over 40 today. I don't know if we'll close there or not, but we're hit it again, which that forecast came to fruition based upon, this cycle of war and peace and inflation. There's a few other things like political functionality, and then the other part of the equation, which is right up your alley, is something I call the culturally enabling paradigm shifting technology, which I believe AI is. And I think there's a quote that I have that Jamie Dimon said recently that it's like the printing. I mean, these are the things I reference when I talk about it, like indoor plumbing, air conditioning, the combustion engine, the automobile, the wheel, fire, that kind of stuff that changes society and the planet globally, everybody, and also impacts everybody individually. So I think that's where we're at. We're probably in the early middle innings. I equated it to somewhere around, as I mentioned before, the sort of Windows, 95, 92, 93, 94. I think it's where we may be at with AI, and it's really just early there. So
no, I agree with you. We're in a super cycle, and the super cycle is at the very, very, very beginning. And I, again, because I interface with very senior people at some of the largest tech companies, I've never seen the level of enthusiasm and excitement. Now, having said that, there are companies diving into AI that probably don't need to, but they're doing it because that seems to be the bright shiny object that goes on. And what's interesting to me about what you do is that over the last, tell me if you think my observation is wrong, over the last 20 to 30 years, as more mainstream people have gotten into the market, they tend to glom on to, flashy stocks. Not to say that's wrong, but the Apples of the world, Microsoft, and
even the spec stuff, the fly by night crazy
yes,
stuff.
exactly. But what I like about you, what you do is that when you look at numbers and trends at a macro level, even a non-macro level, it takes the emotion out of things. And sometimes when you buy individual stocks, you tend to buy an emotion, and not all the time.
I mean, the key to investing is checking your emotions at the door. And it happens to all of us all the time. I always want to have another trader. I give them our buy limits and our stops and our price points. Just execute it for me. I don't want to go look at the market and start feeling it, because I'm human as well. But when we look for stocks, now I came into the business with Yale in early 90s, and we had a publication called Ground Floor, which is a great name, but we just picked small stocks, micro caps, and we were calling CEOs and chairmen and running numbers and looking at projections and all this. And we did biotech stocks and Vancouver mining stocks and little tech stocks, all kinds of things. Always looking at valuations, price to sales ratios, and was the number one thing to start, because you can't manipulate revenue so much. But what we've evolved into is using a real robust screen where I'm not talking to anybody. I'm just letting the numbers, the 10Ks, the 10Qs, show us that a company is exhibiting an acceleration of growth in revenue and earnings sequentially, quarter over quarter and year over year, and they've got good valuations, and there's some, relative strength. Not a lot. They're not beating the market. They're not lagging the market, and they're underfollowed. So these are the kinds of off the radar stocks that I pick. Super Micro was a pick of ours back in 22. Yeah, I know other people were in it much earlier, but in November 22 at 81.93, it came through our screens. We sold it. We sold half of it twice. We always sell half on a double. You take your initial investment off the table, and we did that twice. So we got a quarter position left in that in the portfolio for the newsletter, and that's where all this happens. We take the Stock Traders Almanac and put all this wisdom, convert it into knowledge, and we construct portfolios using the seasonals, the cycles, fundamental analysis, technical analysis, sentiment, and macro trends, like we're talking about monetary policy and this like big technology boom. And that's what we do for our subscribers on a monthly, weekly basis. We're giving them stocks, ETFs, sector rotation, market timing for the broad market. We just had our NASDAQ best 8 months, MACD, the technical indicator sell signal back on June 25th. So I know we went a little higher since then, but use a trailing stop to, stay with the gains. And it's just been, the cycles have been just hitting on all pistons.
Now, the question I have for you before we go into some of these data analysis trends that we're going to talk about in a few moments, how do you comprehend maybe non-tangible, non-numeric stuff? For example, the quality of a management team, the track record of the CEO. There's obviously market trends, which are probably a little bit easier to understand, but some of the things that, it's hard to put a score management team and put that into a spreadsheet. So can you talk about that for a few moments?
I've done that before. I don't do that anymore. I let the numbers. I really don't score management teams. I don't talk to them anymore. If their earnings are going up and their revenue is going up, the management's doing something. You can look at, insider ownership. Insider buying is good. So they got some something in the game. But I don't really evaluate that. And like an example, Scotts Miracle-Gro came through our screens a bunch of years ago. We had no idea why. Didn't really care why. We'll figure that out later. And then as we started updating the stock, in the newsletter, they bought this hydroponic. They're getting into they were benefiting from the cannabis business. So you'll find out what the management's doing, what the quality of the management is from our vantage point, while you see this acceleration of growth and earnings and revenue sequentially and year over year.
So you're a data only guy. It sounds like you're a data guy.
Pretty much, but we do overlay our seasonals, which is data based. Seasonality is a type of technical analysis. It's price over time. So we're going to use our knowledge of patterns and cycles in conjunction with stock data and sector data, as well as, you look at the chart. If it's going down on the chart and it's not, you got to have a little bit of savvy with how you evaluate the performance of it. If it's not tracking the cycle or setting up well, you got to pass on it.
Yeah, so let's go into some of these slides that you forwarded to me before, because this is just a small sample of the stuff that you put in your newsletter. But and again, this is a bit of an eye chart. It's hard for people to read this unless they blow the screen up. But talk to me about this in terms of what we're seeing. It kind of looks to me like an electrocardiogram, but anyway, yeah.
So this is from our members only webinar from the 3rd of July, just before the 4th, where we really spent some time with our subscribers, our members. We run through maybe 20, 30 minutes of prepared, slides and remarks, and then we just open it up to questions for at least a half hour, if not an hour. So this is just a picture of the NASDAQ composite. You can see, the bar chart. The bottom is the two technical indicators, the short-term buy MACD and the longer-term sell MACD. Don't want to get too technical. And I've just highlighted with the green line from the yellow box on the left, which is where our buy signal was in October, the last month of the worst months, the beginning of the best of months period. And then our sell signal in June, the end of June, which was a MACD crossover sell signal, a technical indicator in a seasonal, strategy window there. NASDAQ was up 31.4% from, the day of our trigger on the buy and the trigger on the sell. And, it's a pretty solid trade for, we do this every year. It's not this great every year, but this is emblematic of the type of experience or the type of profits and returns you get using seasonalities combined with technical.
Right.
So the best 8 months for NASDAQ. Good.
And it also underscores, I think sage financial advice that, a lot of, again, people that I speak to, they want to hit a home run every single time. And, my deal and again, I'm not a financial advisor by any means, but I'm always a big believer that, hey, if I have pretty solid gains, in a a mutual fund, or even an individual stock, but generally a mutual fund, I would rather take money off the table, and having a nice gain. But you tell me what in terms of what your advice.
Now listen, you bring up something interesting because I just finished reading, the 2025 almanac, and there's a part in there about selling. It's in the back. It's just from this guy Gerald Loeb, GM Loeb. He was an old, market advisor, trader from the old days. And when it comes to taking money off the table or taking profits or selling something, you want to go against your inclinations. You want to sell your losers and let your winners ride. If you got a winner, if it doubles, you can take your initial investment off the table and then sell some more. But you don't want to just sell because something seems overvalued.
Right.
You want to get rid of the stuff that's not working. All right, or sell your least favorite idea and buy your next favorite or most impressive analysis. So you want to take some money off the table, but you're better staying in with winners. Let your winners ride, sell your losers short, than just trying to take profits all the time because you make money by sitting in there. So long haul, these things work. We get our 10 baggers, like Super Micro and others here and there, but you can't just play for the fences every single time. You got to go for the base hits, the singles. You got to move everybody around there. And like Buffett says, the market's got to keep pitching, but you don't have to keep swinging. You can sit there on the bat, with the bat on your shoulder, and wait for that fatter pitch. So
now, when you look at here's a chart of the S&P 500 versus the Nasdaq, again, given that you tend to be very data oriented, you're looking at the numbers, but do you skew toward? Do you let the market? Well, the S&P is performing better than, let's say, the Nasdaq or vice versa, or do you just look at the macro market performance kind of speak for itself?
We'll go where things are working. I think that plays more into our stock selection process, where we're looking for companies that are doing very well, P&L and balance sheet wise, and that'll give us an idea as to what's going on in the market. But when it comes to the seasonal trends, with say like when we get our buy signal in October, I'm buying the Dow, the S&P, the Nasdaq, and the Russell 2000. And because of the historical record of these seasonal patterns, it continues to work until today, as you're seeing right here in these charts. These are some of the positions that we'll hold without a stop because we've got the seasonality and the history of that behind it. But when it comes to our other sector trades and the stock trades, we put in protections there. So I know everyone's talking about the small caps right now that are rallying, they're coming off the ground, and it's intriguing, but it's a seasonally weak period. So I'm going to be apprehensive about getting into the Russell 2000. As a matter of fact, I sold my IWMs a little while ago on the 25th sell signal. Admittedly, a little bit early, but I was in October. So if you're in ahead of the major part of the historic seasonal move, it's okay to miss a little bit. There's only only liars sell at the top and buy at the bottom.
Now, the one thing, this is an interesting slide right here, but the one thing I do want to hit, because I don't want to not cover this topic.
Yeah.
You had an intriguing discussion over dinner a month ago about, because it's hard sometimes to separate politics from the market, from business, and not to get into a political discussion because I don't want to do that. But you made an assertion to me that was really interesting. You said, Mark, at the end of the day, whether the Democrats win or whether the Republicans win, I look at the data and there's really not a lot of variability, which sometimes surprises people because the Republican Party is known as a more business oriented, lower taxes, lower regulations, which I think is accurate. But
and that's expected if Trump comes in now.
Right. So, but you stand by the fact that even if there is another, if Biden wins or whoever might replace Biden, that's another conversation. You think that at the end of the day, the market's going to do what the market's going to do, and it's really it really doesn't it doesn't skew heavily toward either political party being in power.
Especially not in the White House. It skews more heavily towards the political party in power in Congress.
Right.
They control the purse strings. We have a
Right.
page in the almanac about Republican Congresses and Democratic presidents are the best combination for the market. You've got
Yes.
which is we can get into that, but it's also the cycle and the fact that there's a bunch of irregular elections been called around the world. In Europe, we got France and England, and Britain and all that stuff. But here in the States, we have our election every 4 years on the same day, and that creates a regular pattern.
Right.
And you see whoever is coming into power or gets into power, they're going to behave in a way that's conducive to them retaining power or having their party retain power. So they come in the first couple of years and they take care of the least savory business. And that's why you see these midterm bottoms like we had and bear markets that we had in 22. And then they prime the pump in the third and fourth years so that everyone's fat and happy going to the polls. And, that's why we have these banner years in the third year of the cycle, the 4 year, the pre-election year. So for me, it's more the cycle. And I even think, again, I'm going to quote our favorite Wall Street CEO, Jamie Dimon, who was in the news again today. I think it was him that said, it doesn't matter who's in, we can adjust. We're ready to make adjustments based upon whichever party's in power, whichever administration's in there. So,
Right.
Right. And that's a 4 year cycle. That's one of the other slides I sent you. But this one is this is actually ending right here. This Christmas in July you've got here. Today is the 9th trading day of July, which is the end of NASDAQ's 12-day mid-year rally from the last 3 days of June and the first 9 days of July. Last I looked, the market was up. I think the Dow was making this new high today. So this little spike is happening. But after that, maybe we get a little soft patch. We've got the conventions.
Right.
Some of the political stuff is that people, their attention gets taken away from the market. Excuse me. You've got the summer doldrums. And then you've got this, convention stuff where everyone's going to be sort of at least.
Good observation. That's going to be very interesting to see how the market performs next week.
It's like rubbernecking on a highway. It's people just going to stop and look and say, "Hey, whoa, what happened over there?"
Right.
So
but here's a slide that you sent me that I think was really interesting about the breather part. So explain this slide.
Well, this is just some of the seasonal patterns for the S&P 500 in election years. You've got all election years. We had a really big first quarter, so we got these all big Q1 election years. Sitting president running, he's still running, and then we've got our aggregate cycle, which is a combination of all years, election years, and the fourth year of the decade. And then this down April. April's a really great month, so when April's down, it makes you wonder. But May and June were up, so we've got that. But of all these different concoctions or iterations of the election year seasonal patterns, you can see, and this was a few days ago. The pink line in 24 is up higher by a standard deviation or two, and it sets up for some mean reversion. And we're seeing some other technical things that are suggesting potential pause. It doesn't mean it's got to fall back, but it means we might mark some time for a while until the market catches up or the cycle catches up with the market. So that's just. And it runs with August and September, worst 2 months of the year. We've got a sitting president that may or may not stay in. Everyone's talking about that. We've got a couple of conventions. There's Fed talk. There's all sorts of distractions right now, in addition to the usual seasonal patterns and the usual election year patterns. So to me, it sets us up for. I'm talking single-digit percentage pullbacks, maybe 6 to 8%, 5 to 10, 3 to 8, somewhere in there. And here's
this is a biggie from a takeaway standpoint.
Yeah.
I mean, especially if you look at it at a 4 year view.
So ever since the first edition of the Almanac, we've been focusing on this election cycle, the 4 year presidential election cycle. You hear a lot of people talking about it these days. We all owe a bit of gratitude to my father for putting this on the map, really, and driving it home. So in these dotted lines, this is the 4 year cycle going back to 49, which is the first full 4 year cycle after World War II. Again, we know things changed. It's not the same economy or market or world before World War II, the military-industrial complex, whatever, all the different industrial complexes. So you can see the post-election year is the year after the election, which would be next year. Is some relatively positive, up about 5 or 10% depending upon the index, and then you see this midterm election year, bottom pickers paradise is what we call it. There's this sweet spot of the 4-year cycle, which is 3 quarters from Q4 the midterm year, which was 22, and to Q2 of the post-election, pre-election year, which was 23. You can see that that the end of the midterm year and halfway through the pre-election year was pretty solid gain. And here we are again moving up in the election year and tracking this. Like we're a bit above on the NASDAQ, the blue line and the S&P are way above history. But again, you're comparing 1 year to a consolidation of 75 years or so. And this is just something that is not always playing trading well or tracking well. End of the millennium, every year was up. There was very little cycle. There's been a couple other COVID and other exogenous events did roil the cycle, but here it is tracking very closely again. And this is one of the things that is very impactful. I mean, Wall Street is impacted by Washington. What policies happen there, and as you're bringing up, it's not necessarily which party is there, but the fact that there are changes that are being made, and people that manage billions of dollars, trillions of dollars, are watching what the politicians are doing because it's going to impact their bottom lines, their shareholders, and their companies. So this is what
the point you made is that it seems that even the data supports that even when there's split government, that's when the market tends to perform the best because you've got balance in Washington. You've got one party checking the other party. So that's kind of interesting.
Yeah, it's much better when you've got the conservatives running the purse strings and the progressives coming up with some new ideas to try to move forward in the world. It seems to be the best combination.
So as we kind of wrap this up, Jeff, any kind of I've got your QR code up here so people can get to your almanac and presumably become a subscriber to your newsletter. Any words of wisdom toward here at the end?
Well, I mean, I think for next year, I'll give you a little sneak peek. It's a post-election year, but arguably it's going to be the 5th year of one of 2 people with Biden still in it. And what we've seen is these post-election years perform much better than they used to back in the old days, before World War II. Since '85, post-election years are the best year of the 4-year cycle on average. Pre-election years have one year gain. So one year more of gains. So the bull market is intact. There's a lot of noise out there. We're in this seasonal weak period. You can wait for that fatter pitch. If you're looking at the market here in the summer, there's no rush to get in. Beware of all this summer rally hype, and I'm expecting a little bit of a soft patch here going into the fall, and then a 4th quarter rally, and probably take us into at least the first part of next year. AI is here to stay. If you want to find some new stocks, come check me out, and go to stocktradersalmanac.com, or I'm on Twitter with you at Almanac Trader. And if you got questions, comments, ideas, we're always open to hearing from people.
Well, Jeff, that's great. Thanks for taking the time to join me for today's podcast. For our viewing and listening audience, please make the Smart Tech Check podcast part of your day or commute. Please make sure that you hit the like and subscribe buttons at the end of today's podcast, or use these convenient on-screen QR codes to connect with me. You can also follow me on X, formerly known as Twitter, at Mark Vena Tech Guy. Jeff, thanks for a fabulous podcast, and I'm sure we'll have you on again. Have a great weekend.
Thank you, sir. Be well.